Hi everybody, this is Lara with your end of the week video analysis for the S&P 500 for the trading week ending Friday the 27th. We've got some bearishness at the end of the week. On the weekly chart, the AD line gives us a bearish signal, and we've got a doji candlestick followed by a shooting star pattern, and so I am expecting either a very shallow sideways consolidation or a somewhat deeper pullback to unfold probably for most of next week and maybe even into the following week. Overall, I still expect the S&P is in a bull trend. There will be pullbacks and consolidations along the way. The next target after this consolidation, the next target is at 2915 for another consolidation to last about 2 weeks. But the invalidation point must remain at 2743.26. Let's take a look at the Elliott wave count first and we'll find out why. My Elliott wave count still expects that the S&P is going to be in a bull market for another year or so. My next expectation for it to end is going to be October 2019, and the target for it to end remains the same at 3616. Super cycle wave 5, I have that beginning in March 2009, the end of the global financial crisis or credit crunch. At that point, I'm seeing an impulse beginning upward, and I'm labelling it Super Cycle Wave 5 to end Grand Super Cycle Wave 1. So Super Cycle 5 is unfolding as an impulse, and within the impulse, the fourth wave is over here, and the fifth wave begins. So I expect this market, this aging bull market, is now in a fifth wave at two very large degrees to complete a huge impulse, possibly for a huge first wave to last multi-generations. And so the trend change that I am expecting when this aging bull market is finally mature and it finally turns into a bear market is a massive, massive trend change once in multi-generations. And so the resulting bear market I expect will be very, very huge indeed, but we are not there yet. The structure for cycle wave 5 needs to complete, and it's probably going to look like a pretty obvious 5-wave structure at the weekly chart level, because for the S&P at this time frame, that's usually how its waves unfold. That's usually what they look like when they're completed. So far we have primary 1 and 2 a zigzag, and primary 3 an incomplete impulse. When it's done, we'll be expecting another multi-week to multi-month correction for primary 4, and then a final impulse up for primary 5. Primary 3 may only subdivide as an impulse. So far it has intermediate 1, intermediate 2 a deep double zigzag, intermediate 3 an impulse, ending with some commodity-like behaviour, intermediate 4 a very shallow triangle exhibiting very good proportion and perfect alternation with intermediate 2, and now I'm expecting intermediate 5 is extremely likely to make at least a slight new high above the end of intermediate 3 to avoid a truncation, and with new all-time highs from the AD line and on balance volume, that's very strongly indicated. Now it doesn't have to happen like that, it just has a very high probability of being the case. There's nothing in Elliott wave analysis nor classic analysis which is absolutely certain. Within intermediate wave 5, no second wave correction may move beyond its start below 2594.62, but at this stage, if we were to see any much deeper than expected pullbacks, I would now expect very strong support about the lower edge of this Elliott channel. This is drawn using Elliott's second technique from 2 to 4 with a copy on 3. Let's take a look now at how intermediate 5 is beginning at the daily chart level, where the end of intermediate 4 triangle is this point down here. Intermediate 5 looks like it's unfolding as an impulse. So far we have minor 1, minor 2 an expanded flat, minor 3 an incomplete impulse, subdividing 1, 2, we could have 3 over on Wednesday's high, and 4 could continue sideways next week. Minor wave 3, the target remains the same for it to exhibit 1.618 times the length of minor 1, about 2915. That's the most common Fibonacci ratio for a third wave to exhibit, and it fits nicely with the higher target of intermediate wave 5. Were intermediate 5 to reach only equality in length with intermediate wave 1, it would be truncated because intermediate wave 1 was quite short, and so I'm using the next Fibonacci ratio in the sequence for the target for intermediate 5 to equal 1.618 times the length of intermediate wave 1 at 2922. Attention now turns to the end of this upward movement here. Now it could be as I have it labelled on the daily chart. Minute wave 3 could have been over at this week's high on Wednesday, and minute wave 4 could have begun in the last couple of days at the end of the week. However, if that's the case, it has to be really shallow. Now that's okay, it could be. Minute wave 2 is very deep. It subdivides well as a single zigzag, and I think it was a 0.97 depth of minute wave 1. And so to exhibit alternation in depth, it would be reasonable to expect minute wave 4 to be very shallow. But it's going to have to be very shallow indeed, because there's very little room now for it to move into. It cannot move into minute wave 1 price territory below 2743.26, which is this high right here. Now it can touch that point, but it cannot move below that point. So a new low by any amount at any time frame below that point means that my labelling here of minute 3 over up here is wrong, and this is not minute wave 4. If that happens, then I will pull the label of minuet 3 back up to this high here, and I'll expect that downward movement could be minuet wave 4 and not minute wave 4. So I'll be moving the degree of labelling for the consolidation down 1 degree. Minuet wave 4, if it began here and it continues next week, may not move into wave 1 price territory below 2743.26. At the hourly chart level, this follows on from labelling at the daily chart level. Here's the start of minute 3. If it's a complete impulse, there are some pretty good Fibonacci ratios here. If it's a complete impulse, then I would expect minute wave 4 to break out of the channel that contains minute 3. This is an Elliott channel drawn using the first technique from 1 to 3 with a copy on 2. The indication that this upward movement is over and the following correction is underway would be a breach of that channel. Minute wave 2, remember, was a very deep zigzag. I think it was 0.7 the depth of minute 1. So if minute wave 4 is beginning, we should expect it to be very shallow, and somewhere around about the 0.236 Fibonacci ratio seems reasonable. There's not a lot of room for it to move into though. It can't even be as deep as the 0.382 Fibonacci ratio because that's below the invalidation point. If minute 4 exhibits alternation in structure, then it's most likely to be a flat, a combination, or a triangle, and within all of those possible Elliott wave structures, that can include a new high above its start, as in an expanded flat, a running triangle, or wave X of a combination. If we do get a new high above this point, then I'll be looking very carefully at strength or lack of it within upward movement. If it's a B wave, it should exhibit weakness. We should see some divergence, maybe with price and stochastics. We should see weakness using MACD as an indicator of momentum, and a B wave also should have weaker volume. If we see weakness, then I'll expect it's a B wave. But if we see any strength, then I'll label minuet 3 and minuet 4 over here, and I'd expect minute 3 is not over. Let's have a look at that idea. It's all the same to this point here, 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 and here. And now, what if only minuet 3 was over at Wednesday's high? Still fits perfectly within the channel. The channel now drawn from 1 to this 3 with a copy on 2, and there is still a very good Fibonacci ratio here and a somewhat reasonable Fibonacci ratio here. I have a judgment for these Fibonacci ratios. If the variation is less than 10% the length of the wave that I'm looking at, then I expect, or I judge it to be close enough to be considered an adequate Fibonacci ratio. But I do think just under 15 points really is pushing it. Anyway, this does fit nicely within the channel. It still fits nicely with MACD. There is a very good Fibonacci ratio within this wave count, but this alternate doesn't have good support at the end of this week from a bearish signal from the AD line. If we do see downward movement invalidating that first hourly chart, then perversely this alternate wave count is going to be considered more likely. It's actually more bullish. It expects that the pullback is going to be more brief than that first hourly chart, although the first one needs it to be very shallow. This one can allow for it to be deeper. Minuet 4 may not move into wave 1 price territory below 2743.26. Let's take a look at the end of the week's candlestick now. I've had a read of Nissan's Japanese candlestick charting techniques book, which I keep on my shelf there, and a shooting star candlestick pattern should be considered a little bit more bearish if it doesn't come after a little gap, and if it doesn't necessarily come after some good upward movement. What we're seeing here, I think, is some slowing of bulls or some weakening of bullish activity. We've got a doji candlestick here, and now we've got a shooting star candlestick. The long upper wick is just over 2.4 times the length of the real body, so this is a shooting star. Taken together, this is a little bit more bearish, and it says to look out for a possible one or more week consolidation or pullback. I'll repeat again that candlestick reversal patterns, though, make no comment on the direction of the following trend that they're saying is reversing. So we can have a reversal from up to down, a 180-degree turn, or we can also have a reversal from up to sideways. It's still a change of trend. Sideways is another direction. And so these two candlesticks don't necessarily say we have to see a deep pullback. They just tell us to warn that that's a possibility. It doesn't have to happen. We could just see a bit of sideways movement. For the bullish case, there's good support from volume for 3 weeks in a row, and we do have upward movement with higher highs and higher lows. On balance, volume at the weekly chart level is extremely bullish. New all-time highs from on balance volume have not yet been met by new all-time highs for price. This tells us it's very, very likely that price will follow on through. Now, it doesn't have to, but the balance of probability is very strongly in favour of a new all-time high for price here. RSI is neutral. There's plenty of room for an upward trend to continue. ADX still declining. It's a lagging indicator. It hasn't caught up with what price is doing yet. This week just telling us that we may finally have a switch from down to up. But we do still have a series of higher highs and higher lows, the very basic definition of an upward trend. And so do expect it's probably going to continue with consolidations and pullbacks along the way. Use them as opportunities. What about the short-term picture at the daily chart level? We've got a gravestone doji and a bearish engulfing candlestick pattern, along with the reversal patterns on the weekly chart. This is also sending out quite a loud warning to look out for a deeper pullback or a sideways time-consuming consolidation. Now, in the very first instance, I would expect pretty good support here, about 2800 to 2810. If price can close below 2800, then next support, most strong support, is at the lower edge of this last measuring gap here, which is about 2765. So if we get a break below here, the next area of strong support to look for is about 2765. The moving average situation still remains full bore bullish. The short is above the mid, is above the long. They are lagging indicators though, but at this stage, with the data in hand, this is a full bore bullish look. We do have a bit of a long lower wick on Friday's candlestick pattern as well. So although we have pretty good bearish candlestick reversal patterns, there's a little bit of bullishness here and strong support. So in the first instance, let's look out for sideways consolidation while price remains above support. If it breaks below support, look out for next support below. Downward movement for Friday did not have support from volume. It doesn't have to. The market can fall of its own weight for a wee while. ADX for Thursday finally told us we may be in a new upward trend, but for Friday, there's a pause to that. ATR is still really quite low. We may be again, like I keep saying, back to that prior market condition of low and declining ATR, contracted Bollinger Bands, and low volatility while price slowly limps on up higher. Remember, this is a very old bull market, and we should expect toward its end to start to see some real weakness develop, and that should be beginning around about now and may continue to develop for over a year before the bull market is finally fully mature. I've got a new weak support line for the very short term here from on balance volume. It's only got 2 anchor points. It might offer a bit of support. A break below that line would be a weak bearish signal. A bounce up from the line would strengthen technical significance at the line. RSI is neutral, there's plenty of room for price to rise or fall. Stochastics is still overbought, but when the S&P has a good bull trend, this one can remain overbought for quite a long period of time. We do have some reasonable weak it's reasonably weak, but there is single bearish divergence here at highs between price and stochastics. So this is another little warning that we may expect some consolidation or maybe another reasonable pullback about here. The pullback could be as big as this. That is possible, but in the first instance, let's look for price to remain above this high, and that's where I have the end of that first wave. MACD fully bullish, again that's a lagging indicator. Bollinger Bands were starting to widen with upward movement, starting to offer a little bit of support to that trend, and now for Friday they're contracting. So expecting at this stage that Friday's downward movement may be a counter-trend movement. Bollinger Bands, not always, but do tend to contract with counter-trend movements and consolidations and expand as the market trends. What about VIX and the AD line? Let's have a look at the weekly chart first. Before we had these 2 weeks of quite spectacular downward movement, we had some really strong warning from inverted VIX at the weekly chart level. In the first instance, between this high and this high from price, these are the corresponding points on the inverted VIX weekly chart. We have some reasonable bearish divergence. Price was moving quite strongly higher, but inverted VIX was failing to make corresponding highs. And then for 1, 2, 3 weeks in a row, price moved quite strongly higher. These are actually quite strong bullish candlesticks, particularly the last one. But for those weeks, inverted VIX moved quite strongly lower. That's really good, strong divergence. The strength of the divergence was matched by the strength of the following movement. At this point in time, we have some shorter term and weaker bearish divergence between swing highs. And now we have 2 weeks in a row of price moving weakly higher and inverted VIX moving weakly lower. So we do have a similar situation. It's not as persistent and it's not as strong. And so let us consider this a warning. We may be looking at a deeper pullback or maybe even just a choppy sideways consolidation for another week or two in response to this warning. What about the daily chart level? We've got a cluster of bearish signals now between price and inverted VIX on the daily chart. Taken all together, this is again a warning to look out for another pullback or possibly a choppy consolidation to resolve this bearishness. For Friday, inverted VIX has made a new swing low below this price swing low, but price has not made a corresponding new low. So I'm reading this as short-term bearish divergence, but at this point I'm considering that we have a cluster here, and so I'm looking out for the possibility of a deeper pullback. At the weekly chart level between the AD line and price, last week we had a new all-time high from the AD line. That's extremely bullish. Price has not managed to quite follow on through yet with new all-time highs. This week we have a rise in price, a higher high and a higher low, but we have a decline in market breadth. The rise in price this week is not supported by a rise in market breadth, and so this is bearish divergence, and this is probably the strongest bearish signal we have this week. Now it may be resolved by some sideways movement, or it may be resolved by another multi-week deep pullback. Look out for that possibility. For the very short term though, it was only on Thursday that at the daily chart level we saw a new all-time high from the AD line. So in the first instance, like I said when we looked at that price chart, there is some bearishness about, but it's really not enormously strong. And so in the first instance, let's consider a choppy consolidation with support about 2800. Only if it breaks below that, then look for a deeper pullback, possibly in the early stages. And consider these pullbacks and consolidations as opportunities. That's the market presenting you an opportunity. Have confidence, or reasonable confidence, as much as any can be had, that this market is very likely to go on to new all-time highs. That's all from me at the end of the week with your S&P analysis, and I hope that all of our members are having an absolutely fabulous weekend.